Stablecoins have become a crucial part of the cryptocurrency landscape, especially for those of us here in the United States. Today, we're diving into a comparison of two giants, USDC and UST. With regulatory scrutiny ramping up, understanding their differences is not just beneficial, it's essential. Why? Because the decisions made by regulators could reshape how we use these digital dollars in the future. So stick around as we explore what's at stake and how these stablecoins could impact your investments moving forward. As of now, both USDC and UST are under the watchful eyes of regulators like the SEC and the Treasury Department. In fact, USDC, backed by Circle, recently revealed that it holds over $27 billion in reserves, which are crucial for its stability. On the other hand, UST has been the subject of scrutiny regarding its reserve transparency, especially after a notable drop in its market cap by around 12% this past year, signaling potential investor concerns. The regulatory landscape is shifting rapidly. Just last month, BlackRock publicly expressed interest in integrating stablecoins into its investment strategies, which could open new avenues for U.S. investors. This is significant because it underscores the growing acceptance of stablecoins in traditional finance, making them more appealing to both retail and institutional investors. Platforms like Coinbase have already embraced USDC, allowing users to trade and utilize it seamlessly within their ecosystem. The integration of stablecoins into popular exchanges not only enhances liquidity, but also enables quicker transactions without the volatility associated with other cryptocurrencies. For U.S. investors, understanding these dynamics is essential. The growing regulatory scrutiny may lead to new compliance requirements that could either strengthen the market or create additional roadblocks. Staying informed about USDC and UST regulatory status could be the difference in how you approach your crypto investments moving forward. Let's break down how USDC and UST can impact your investment strategy as a retail investor. Imagine you decide to invest $1,000 in stablecoins this week. You've got two options, USDC and UST, both available on platforms like Coinbase and Kraken. Now, let's say you choose USDC. With its backing by Circle, this stablecoin aims to maintain a consistent value. If you purchase it on Coinbase, you might face a fee of about 0.5%, costing you $5 to buy $1,000 worth. This gives you $995 in USDC. On the flip side, if you opt for UST on Kraken, the trading fee is typically around 0.2%. So, for the same $1,000 investment, you'd only pay $2 in fees, leaving you with $998 in UST. But here's what nobody is saying. While UST may seem cheaper at first glance, its regulatory scrutiny could cause value fluctuations. If something shifts with its compliance status, it might not hold its peg as effectively as USDC. For instance, if the market sees a sudden drop in confidence toward UST due to regulatory concerns, that $998 could quickly diminish in value. Conversely, UST clear compliance with U.S. regulations may provide a more stable experience in the long run. So, while you might save a few bucks in transaction fees with UST, the potential risks tied to its regulatory environment could mean a lot more in terms of actual dollars lost if things go sideways. When making your choice, consider both the fees and the inherent risks. Investing $1,000 in UST might give you a little less upfront, but it could protect your investment better down the line. In the ever-evolving crypto landscape, a stablecoin that aligns with regulatory expectations can be a solid choice for U.S. investors looking to safeguard their assets. If you're considering diving into stablecoins like USDC or UST this week, here are 4 actionable steps to help you navigate your investment. First, check your tax obligations. Understand how stablecoin transactions may affect your capital gains. The IRS treats cryptocurrencies as property, so every trade can have tax implications. Make sure to consult a tax professional if you're unsure. Second, set up a secure wallet. Whether you choose a hardware wallet or a reputable software wallet, prioritize security. Transfer your funds directly from an exchange like Coinbase or Kraken to your secure wallet, minimizing the risk of hacks or theft. Third, consider a small initial investment in USDC. Aim to invest around $100 to $500, depending on your comfort level. By using platforms like Gemini or Crypto.com, you can easily buy USDC and begin to familiarize yourself with its stability and use cases. Finally, explore DeFi options for earning yield on your USDC. Platforms like Aave or Curve allow you to lend your stablecoins and earn interest. Make sure to do your homework on the risks involved, including smart contract vulnerabilities. By following these steps, you'll be better equipped to make informed decisions about stablecoins in the current regulatory landscape. As we look ahead to the next 90 days, the The regulatory environment surrounding stablecoins like USDC is likely to evolve, with the SEC and other agencies fine-tuning their guidelines. Investors should stay vigilant and adapt to any changes that may impact their holdings. What are your thoughts on the future of stablecoins? Will USD emerge as the safer option? Subscribe to the channel for daily crypto updates and keep the conversation going.